My name's James. Good afternoon. I'm the Managing Director at IHUS. We're delighted you've joined us to discuss a topic that is very important to many families considering an annex, inheritance tax and related financial planning being the subject matter. Today, we are privileged to have Paul with us. Paul is a chartered financial advisor from Lyonhurst Wealth, based in Sheffield.
That's it.
Yeah. With a lot of experience in guiding families through the complexities of inheritance tax and estate planning.
Thanks, James. Happy to be here and looking forward to getting involved in this.
So I'm just going to put the presentation up. So can you see the presentation?
Yes, thank you.
Sorry, this is the first time I've held a webinar for a while, and we'll have to do it. That's on screen here. Okay, so the main reason that we planned this webinar is inheritance tax worries are common among families considering an annex, and we wanted to provide you with professional advice directly from an expert in the field. Here's what we'll cover. Financing the build of your annex, making the most of surplus cash, addressing recent family inheritance tax questions we've received, which may resonate with you, understanding deliberate deprivation in the context of care, a deep dive into inheritance tax and estate planning, including equitable share. Finally, we'll have time for questions, some of which you've already sent to us, but please feel free to put your questions in the chat throughout the webinar. We'll also welcome you to unmute yourself and talk directly to us at the end if that's what you feel comfortable doing. We hope the session will be informative and provide you with the clarity you need to make informed decisions. Before we begin, I want to thank everyone for attending and let you know that at the end of this session, you'll have the opportunity to book a 15-minute consultation free of charge with Paul to discuss any personal matters directly. Thank you again, and let's get started.
Yeah, let's get started.
So I'll move on to the first slide. Is that the first slide coming up for everybody okay?
Yeah. Yes, thank you.
So over to you, Paul.
Oh, apologies. Obviously one thing that's an initial consideration for people is how is the build going to be financed? A number of ways in which clients potentially will look to do that. If they've got disposable cash that's available, then that makes things a little simpler because it's readily available, it's liquid. Sometimes it may need disinvesting, but potentially there's around whether that's appropriate and whether there's any more efficient ways of doing that. In most cases, there will be a sale of a property. Generally, the parents will be looking to sell their property. Some of those proceeds will go to building the annex. Again, it's around what are the implications of that. Is that the most appropriate course of action? Are there any more appropriate alternatives? And again, that's all individual basis. Pensions also something that could be considered. As most people are aware, you can take 25% of pension fund if it's a defined pension, and you can take tax-free cash out of that. If you've got a large enough pension fund, that could be used either in whole or in part to fund the build. And again, there's a question mark there around whether that's appropriate. What's the impact of retirement in a wider context? If you take a large chunk out of your pension, how does that impact on the sustainability of the rest of your pension fund, etc.? So again, much wider conversations. Lifetime mortgage is something that in certain circumstances can be used. There's also other ways of securing borrowing to be able to fund the build. Bridging finance on the list there as well is potentially one of them. And there's also a new breed of mortgage products out there called retirement interest only, which again, in some circumstances, can be beneficial, can be useful, can be appropriate. You will hear me use words like potentially, possibly, maybe a lot during this process because, again, there are lots of different permutations, different scenarios. Everything is done relative to what's beneficial for that particular client. So Again, that's why we look at things individually and we have that individual discussion with potential clients. So just moving on to some of these points in detail, obviously surplus cash is the most straightforward way to fund the build. But again, you know, there's got to be a conversation around what happens if you commit a big chunk of surplus cash to something relatively illiquid. So again, it's around, whilst that might be the simplest, easiest and most obvious way to fund it, is it actually the most appropriate? Again, if you're going to leave yourself short in terms of liquidity, then it might not necessarily be the way forward. You've also got to consider, you know, what we call opportunity cost. You know, if you've got that cash invested somewhere, how will that perform, or how would it be expected to perform over a longer period relative to how the value of the property might grow, if that's where it's ultimately going to be deployed? And what's the impact on the estate? You know, if you're taking a large chunk of cash and you're using that to purchase an annex, you could look at it both ways. In one context, it could reduce the value of the taxable estate. There are implications in terms of how that's treated in terms of gift, etc. So it could actually help to reduce an inheritance tax liability overall. But again, there's other implications to bear in mind as well in terms of losing a residential mill rate band. How is that treated in terms of does revenue constitute that as being downsizing? A little bit of a grey area. So again, it's something that just needs looking at on an individual basis. In terms of IHT, again, as James said earlier, this is something that is really, you know, at the forefront of people's minds. And there are many different permutations, many different things to consider. One of the most common questions is, if I'm going to sell my property for argument's sake for 400,000, I'm going to use 200,000 of that to fund a build in my son's property. Does that mean, you know, should I just leave the other 200,000 to my daughter? Well, again, that's a wider conversation because you could argue that you're not necessarily adding £200,000 of value to the son, but also the son might be there providing care. There's a conversation around who is paying all the bills. You know, will there be a contribution to the house as a whole? So it's not necessarily a straightforward division, and we have to look at things like offsetting. You know, what's most appropriate, and fundamentally, what are the intentions for the parents? You know, what would they want to happen? And it's you know, in some cases it's formalising that. Next question on there, next point on there we've got is around you know, making sure that there's a solicitor involved and the legal side of things is made a little bit clearer. You know, we're very big on making sure that the right advice is provided, not just with ourselves on the tax side and on the financial planning side, but also in terms of formalising how things are going to look. There are a lot of potential considerations. Again, things that maybe people haven't always thought of. You know, for example, if the annex is built in the premises of a son or a daughter, what would happen if the son or a daughter then subsequently got divorced? You know, there needs to be things like declarations of trust, potentially rights of occupation, to make sure that you as the donor, as the funder of that annex, are protected and are secure and do have that right to live there for the rest of your life. So definitely need a solicitor involved in that, or at least a very experienced and very knowledgeable estate planner, and that's something obviously that we can all help with. Is it best to put all the parents' estate and savings into a trust? Trusts are something that we do get asked around a lot. Personal opinion is that the effectiveness of things like discretionary trusts has waned over the years with changes in legislation, etc. I can't say that there wouldn't be scenarios where they wouldn't come in handy, but I think in the vast majority of cases, trusts can be self-defeating, potentially lots of cost, also potentially lots of ongoing cost in terms of periodic charging and things like that. So I'd say for the vast majority of clients and vast majority of circumstances, they're probably not appropriate. But again, as I keep saying, it's going to be individual consideration, and every set of circumstances is going to look different. Care is another implication. again, the legislation around care is something that's been in the press. It's been at the forefront of people's minds in recent years. And one thing that people generally are aware of is that the local authority, if there is not even a residential care need, even if you've got carers coming in, the cost of that care, your estate, your wealth is tested, and if you're over certain limits, you will be expected to self-fund care. And if there isn't the liquidity there, they can put charges against your property. Obviously, that at the point of death or entering a residential care home, the property is sold and the cost of care is reclaimed by the local authority. One benefit of the Annexe solution is that there's no main residence. If you, as someone considering living in the Annexe, are going to forego your main residence and fund an Annexe, you no longer have that main residence. So the local authority isn't then able to secure that charge against that property. There are some rules, which James mentioned earlier, called the deliberate deprivation rules, whereby the local authority do try to prevent people from deliberately depriving themselves of assets so that they can't be claimed in terms of the care trap. But building an annex wouldn't fall foul of that. The local authority would have to prove that the main motivation for disposal of the asset was to deprive yourself of it for care purposes. In this instance, you're actually going the opposite way because you're effectively making your own care provisions. So that wouldn't be the motivation for the disposal. Again, what you'd have to consider is any surplus capital. For example, if there was a sale of a property for 400,000, 200,000 funds, the other 200,000 is within their grasp. So again, the advice is there to be able to look at how can we potentially protect against that if possible. So yeah, care is a big consideration for people. But it's also a solution as well, because as I say, if you are living effectively with the next generation, there is an element of care that them being the caregiver. So again, it's has a lot of advantages, and it is a potential solution. So in terms of inheritance tax, what is the impact on the estate? Most common scenario is mum and dad, or mum or dad sell the property, and a chunk of those proceeds are used to build the annex elsewhere, generally at a son or a daughter's premises. That money would have to be given as a gift. So it's a lifetime gift, what we call a potentially exempt transfer. Potentially exempt in that there's a 7-year rule that applies. So if a gift was given and the donor survived for 7 years, that then falls outside of the taxable estate. So it wouldn't be brought back into the inheritance tax calculation. If death occurred within 7 years, it will be brought back in, and there is an element of tapering relief that's applied to the tax liability.
So what does that mean? So does it, if it's 6 years, well, from 1 to 7, it goes down a total?
Yeah, the first 3 years it's 100%, and then it'll start to drop on a tapered scale to 7 years. There is a solution to that. There are certain policies, life insurance policy called gift inter vivos, which covers that 7-year period and covers the inheritance tax liability on the gift. So if there was a death in 7 years, the inheritance tax, sorry, the inter vivos policy would cover the IHT liability. That's
an insurance policy.
It's an insurance policy, yeah. I keep using the word potentially, possibly, because again, with it being a form of insurance, it is underwritten. So it will depend on things like health, and again, cost comes into that calculation as well. But that is a solution to that potentially exempt transfer issue. Residential nil rate band. This is a little grey area. Not sure how many people are aware, but there are two reliefs available when it comes to inheritance tax and the estate. One is the nil rate band, which is £325,000 per individual, £650,000 for married couples. For married couples, they can also pass on their relief on death. So on the second death, assuming everything was left to the surviving spouse, that would be when the inheritance tax issue became apparent. There's also a secondary relief, which is the residential nil rate band, which was introduced a few years back. And this gives each individual another £175,000 of relief or potential relief if the main residence is left to a direct descendant on second death. Obviously, by disposing of a main residence, theoretically, you can't then claim the residential mill rate ban because you're not then passing on your residence to direct descendants. However, there are some rules around downsizing which allow you to retain that relief if you subsequently move into a smaller property. This is where the grey area sort of becomes more apparent, because it's whether the annex constitutes downsizing to a smaller property based on the fact that it's within the title to another property. This is going to be a very grey area and one that I think we're probably going to need some clarification on from revenue to be able to give you some definitives on that. I mean, they are the two major considerations. But there's also a knock-on effect in that if you are, as a donor, giving money to build the annex at the property of a son or a daughter, the building of that annex is fundamentally going to increase the value of their property, which then has potentially the knock-on effect of increasing the value of the son or the daughter's estate. So again, there's another wider conversation, probably an intergenerational conversation between parents, children, to make sure that all these different angles are covered and that everybody's aware of what the implications are and potentially how we can mitigate that.
If anyone's got any questions, please do, pop them into the chat box, like I said earlier, or we can get to that in a bit.
Yeah, again, we've touched on the equitable part of dividing an estate. This is always very, very tricky because, again, using the example of parents having two siblings, two children, two siblings, a son and a daughter, there is an argument that if you were to sell a property, for example, for 400,000, 200,000 builds the annex at daughter's house. The initial thought is, well, surely we just leave the remaining 200,000 to the son. But that's not a straightforward solution, because, for example, the first thing you've got to establish is, does the 200,000 build cost, does that add £200,000 of value to the daughter's property? That's the first thing to bear in mind. The second thing to bear in mind is, well, what's the intention with the other 200,000? Is that going to be deployed? Is it going to be invested? Will that investment likely keep pace with the growth on the daughter's property in terms of how that's appreciating value? The other thing to consider as well is, if you're living at the daughter's house in the annex, they're potentially going to be a caregiver, even if that's just to the degree of helping with chores, cooking, cleaning, not necessarily providing personal care, but fundamentally they are offering a lot more than just you being resident in the annex in the garden. So again, it's a very, very difficult conversation, something that would need to be considered on an absolutely individual basis. And those conversations would probably be done in line with an estate planner, because as I mentioned earlier, what you would really is a more formalized agreement, which would involve declarations of trust, which spells out what would happen in different scenarios. And that would go hand in hand with things like a rights of occupancy agreement and probably wills, power of attorneys as well, and just make sure that everything and that every angle is covered on that. So again, it's about making sure that all parties are happy, and that's why ideally you would do this as a whole. It would be an intergenerational meeting where we ideally try and make everybody happy. Not always possible, but fundamentally it's going to be, what are the intentions of the parents? Because fundamentally it's their money, it's their estate, what would they want to happen? But as you can tell, these things can get very complicated, very complex. And obviously what we would like to do, and what I would like to do, is always make sure that the duty of care is carried out, and that everybody goes and informed, everybody gets the right advice, and things are structured in a way that suits everybody.
Any questions before we move on? In fact, should we answer the questions that come up now?
Yeah.
So thank you, Peter. Peter Holdsworth, what are the tax implications gifting your house to your children while you still live in it? Say it's 300k each on a house that's worth 300k, that's the current value.
Yeah, to some degree, Peter, it doesn't really change because that would constitute a gift with reservation of benefit. Because you're still resident in the property, you'll derive enjoyment in the terminology of the law. So it doesn't really change anything from an inheritance tax position. It's still within your estate. That changes slightly if you pay rent, because you're sort of creating a line of demarcation between ownership and enjoyment. If you're paying rent, it's just the same really as renting elsewhere. So again, that's where you've got that extra layer of complexity, because gift with reservation benefit rules are complex and do again depend on individual circumstances and what the individual intentions are.
So if you just gift your house to your children while you're still alive, and you live longer than 7 years, is that then considered your children's property and you were just residing in it?
It's still,
and you're not paying rent?
Yeah, the legal ownership changes, but the equitable ownership doesn't. So the equitable ownership effectively still resides within the estate. Because although you've given away the legal ownership, you're still enjoying a benefit. So it comes under the gift with reservation of benefit rules.
So even after 7 years, it's still within the
it's still considered as part of the calculation. Yeah.
Oh wow. Okay, interesting.
Yeah, again, it's revenue looking at ways of making sure that people don't try and circumvent the rules.
Yeah.
You know, that would be an easy way to get around the rules, was to just say, well, I'll give you the legal ownership, I'll stay there, and we'll cut out the IHT issue. Unfortunately, it doesn't. But again, the gift with reservation of benefit rules are quite complex. So look at that in, you know, on its own merits.
Okay, thank you.
Thank you for that, Peter. Valerie, thank you for the question. If I sell my property and give my daughter a lump sum to purchase a larger property, would there be would there be a tax problem?
Yeah, Valerie, it goes back to what I mentioned earlier.
And she had for me to live in as well.
The gift creates basically, again, it's a gift to your daughter. So if she then, you know, what she does with that money is absolutely down to her. The gift would be the consideration there. So again, the 7-year rule applies. You've given that asset away. If she then decides to buy a property with it and you live in there, you've created that sort of line of demarcation. So the 7-year rule applies. You could cover that off with inter vivos cover if that's something that would be appropriate and obtainable.
We'll answer the rest of the questions in a minute. So because we have actually come to the end of the main body of the presentation. So what's next? As already mentioned, well, thank you, Paul, for sharing your valuable insights and advice today. I'm sure our attendees, I hope you found it helpful. Before we open the floor to more questions, I'd like to remind you that Paul is offering a 15-minute chat to anybody in this who's joined us. No fees. It's just to you know, have a 15-minute chat with him directly about your specifics. There's a great opportunity to get personalized. It's a great opportunity to get personalized advice, basically. Additionally, if you're considering building an annex, have questions about the process, please feel free to reach out to me or the team and with the contact details in the slide. And equally in the slide is Paul's email address. But we'll follow up with you all individually with an email, so you've got all the details as well. Now, so let's open the floor to any questions you might have, and please feel free to put the questions into the chat, or if you're comfortable, you can unmute yourself and ask the questions directly. We've also received some questions in advance, and we'll address those during this section. If you have any more questions during this time, please continue to share. So what we'll do is we will go to the questions that are in the box. So we've got a question here from Robert. What if daughter is able to fund the annex and we're able to exchange our property to daughter, but it will be rented by her?
I'm not too sure on the rental part what you mean by that. I mean, if your daughter could fund the annex, and obviously you're going to live there, there's no implication from your perspective. But are you saying that you're going to give your property to your daughter and she'll rent it out as a buy-to-let?
Can you hear me? I can't.
Yes.
You can't. Yeah, yeah. That was a sort of plan for the present time.
Right, okay. Yeah, in that circumstance, yeah, it would be, again, you're gifting the property. So again, 7-year rule, it's a gift. After 7 years, it wouldn't form part of your estate. The one thing that your daughter would need to be aware of is that if she disposed of it in future, the capital gain would be treated, it would be treated as though it was passed on, not from the date that she acquired it. So there'd be quite a large capital gain, and there could be a large amount of capital gains tax to pay if she.
What's the capital gain sort of threshold type of thing? You know,
The tax rate, the 28% in most cases on residential property.
on the full selling cost.
Yeah, capital gains is calculated on the difference between acquisition price and sale price. But I think it would be treated as though it was acquired when you acquired it. I think that's how it would be done. Again, don't quote me on that. I'd have to sort of run back through the revenue rules on that, but that's something that she would need to be aware of, because the liability, obviously, because it'd be a second property for her, there'd be capital gains if she disposed of it. So there would be a capital gains liability that she'd need to bear in mind before, obviously, you went down that route.
Sorry, can you say that again? If for argument's sake the property value is 200,000 when it is sold by my daughter, for argument's sake,
Yeah.
who pays 28% of that 200,000?
No, it'd be 28% of the gain. So the difference between the purchase and the sale price.
But it won't be purchased, would it? It'll be
It'll be, I'm pretty sure it'll be treated as the price you paid for it.
30 odd years ago.
Yeah. Again, I'd have to double check on that, but I'm pretty sure that's how revenue would calculate the gain.
And what would be the case if there was 2 properties involved? Would that be the same?
Same on each, yeah. I mean, if at some point she sold her current property and moved into it, then there would be some residence relief available, which would reduce the tax. But yeah, fundamentally, if it's just going to be an investment that's rented out, on disposal, there would be capital gains issues to consider.
So even if, I know I'm perhaps repeating myself here, if it wasn't gifted to my daughter, if she sort of purchased it for the price that the annex is costing, for argument's sake.
Yeah, yeah, it'd be treated as though as the purchase price. So if she purchased it for 200,000 and sold it for 250,000, she'd be taxed on 28% of the 50,000.
Mm-hmm.
Thank you, Robert. Do you have any more questions on that, Robert?
Well, so the idea was, see, for to probably sign no property to our daughter as the money she's paying to build the annex. You understand what I mean?
Yeah, I suppose that's probably more of a legal question, Robert, because it'd be how that's treated. Is that 200,000 going to be consideration? If it is, then yeah, that gain that she would be taxed on later on down the line would be the difference between the 200,000 and the sale price. So yeah, that would depend on how it's structured, I think, from a legal perspective.
And where would I find that information? Or where would I carry out that sort of?
Well, I'm not sure. Do you have legal guys that you refer to?
That'd be a property solicitor.
Yeah, or
it would be most likely a property lawyer or not financial advisor or Yeah, I mean, we don't work directly with solicitors, but
well, we definitely have someone that we could get put in touch with.
I think that's where the 15-minute chat could be really helpful for anybody like this, where you've got a specific scenario, like Paul said at the beginning, and the same with the buildings and the projects. Actually, the situations are quite specific to you as an individual in your scenario. So I would recommend, Robert, you maybe catch me to Paul and sort of explore this a bit further.
Could I kick in just slightly, because I've literally just put an annex in, and I'm just putting the annex in. I've come on to just listen to the advice and game, but just it might be relevant to the last question. Is My mother sold her house. She gifted me the value of the annex, and my lawyer has put it as a hodgepodge section into her will. What that means is it's a gift. After 7 years, it would be no longer taken into consideration at all, according to the lawyer. The estate, everything that was taken prior to that would be brought into the estate. So if she did pass away prior to the 7 years of the gift, then it'd be brought back into the estate. The purpose of the hodgepodge was just purely to allow for fairness. So my mother has a very standard will where she splits it between myself and my brother. But for fairness sake, because she's building the annex in my garden, basically we set up a depreciation value. So the money is taken into consideration. It's depreciated over 20 years, and the value on her passing will be taken into consideration as part of the hodgepodge clause. So I don't know if that did answer the question, but that's legal advice that I've had sought and had it sought by property experts as well. So
Yeah,
it may help people. I don't know.
We could use that term then, hodgepodge, to a property solicitor.
Yeah, so hodgepodge is a legal term specifically for having something quite ad hoc into the will. And a hodgepodge clause means that you can then define. So the easiest way for the will not to be contestable by another sibling was introducing a hodgepodge clause, which then specifically stated the value of the gift. So a gift was given to me, i.e. for the value of the annex, and the hodgepodge clause basically details the way in which that value should be treated going forward and at the time of the will. So what currently it states is it will depreciate over 20 years at a 10% rate, which was an agreed rate between my brother, I, and my mother. And then at the end of 20 years, it would be zeroized, so there would be no benefit then. But prior to that, that money would be taken from the final estate by my brother before the will would activate into whatever my mother had agreed, i.e. she's agreed to split it across certain parts of the family. That takes place after the hodgepodge clause.
Okay. Wow. Any more?
That was just that's just from my lawyer, and obviously our personal circumstances, but it's definitely for people to consider. Or that seems to be the right way forward. And basically, if she passes before the 7 years, it goes back into her estate and rolls into her estate.
But luckily, there's only one sibling involved here, so it's nothing.
Yeah. So you won't need the hodgepodge, but it will roll into the estate. And supposedly, after 7 years, that loan is not. The only area of risk that was brought to my attention by my lawyer was if there was a need for care and I was looking for the state to provide that care, then they would consider the sale of the property and downsizing to such a degree to reduce your or make you more eligible for care. So if you are looking for state care at near end of life, then that could be a area of contention with the local council.
Okay.
Yeah, there's lots of different permutations and everyone's different. And the key to every scenario is getting the advice. And again, that's not just from one individual. Obviously, I'm there to give the financial planning and the tax advice, but you know, a legal professional who's really well versed in estate planning is essential, because you know, things like declarations of trust, rights of occupancy, all that kind of thing should be considered just to try and box off different scenarios.
Okay. Thank you, Andrew, for that contribution. Really, very helpful. I'm going to move on, and Robert for the question. So I'm going to move on next to Harriet Pike. My mum has just sold her house, completion due in a few weeks. She plans to give me and my sister the proceeds and then use other surplus cash to fund the build of an annex at my property. Would it be better for her to use the funds from her sale to fund the annex rather than other cash?
Yeah, a difficult one to answer, in all honesty, Eric, because it depends on, will she need that cash? Obviously, using the surplus, it may leave her illiquid, but she could have many forms of income coming. She could have pension income, which covers needs and regular expenses, in which case it's possibly not so much of an issue. It would certainly.
Sorry, could I just butt in? It was, my question was more around, she has taken financial advice and has been told that her financial situation is fine for her to fund the annex with other cash. I was just wondering, because you'd mentioned that in terms of, I can't remember the detail you said, but if you use the money from the sale of your house to fund your next residence, even if it's at your child's property, that would be taken into account by the local authority in terms of they couldn't.
You mean for the deliberate deprivation?
Yeah. So it's like, would it be better for her to use? I mean, it's not going to make a material difference to her.
No. I mean, I think fundamentally, what they can grasp at, because she sold the property, the first question that they would look at, if there was a care need, is when was that disposal? How recent was it? And what was the primary motivation? So, for example, if she sold the property and just gave all the proceeds away, revenue would likely take the view that that's deliberate deprivation.
Right.
So aside from any inheritance tax implications, the local authority would say, well, the only reason you did that was to get out of the care trap. If a chunk of that money is used to build the annex, then you've got a very compelling argument that that wasn't the primary motivation. The primary motivation was for you to be cared for elsewhere, effectively, and you funded that yourself. Obviously, the two gifts, they could potentially still take that view that you gave those gifts for the purposes of depriving yourself of the asset. But again, it's on them to prove that. If you would say, well, it was a pre-inheritance, my children both wanted to, buy properties, I'd rather give them now while I'm still alive. That then is where there's a lot of grey areas within the care realm. So it's not a straightforward answer, unfortunately, Harriet. But yeah, wherever the funds come from, there's potentially always going to be that question asked.
Okay.
The fundamental result will be, what was the intention behind it?
Yeah. Okay. Thank you.
Okay. Thank you for the question, Harriet. So now we move on to Kathy Sykes. Please, could you go through the scenario where the child sells the house to move into the parents' house?
Yeah, obviously this is.
Could I just add some information to that, please, James?
Yeah, sure.
I'm sat here with my parents now. I'm the son in the scenario. So we're interested in that scenario. However, I've still got a mortgage on my house. So the sale we're sort of looking at now, if I was to sell my house with my wife and move into my parents' house, we would probably have about half the cost of the annex, about £100,000. My parents would be looking at possibly liquid cash for the other £100,000 with us moving into their house. The problem is not a problem, but what we need to figure out is there's 4 children, 3 other siblings, and the house that my parents' house is going to need quite a lot of renovation that we'd be wanting to do. So, yeah, what are your thoughts on that?
Would the ownership of your parents' property change, or would that still remain as their property, Andrew?
We'd be.
Would the ownership change to you and your wife, or would it still be parents that own their property?
We don't know. It's what would be best in that scenario. Yeah. We would be the ones living in it, so technically, yeah, we would probably be taking ownership of it. But what would be best, I guess?
Again, depends on circumstances. In some respects, leaving it as parents, as owners, may be beneficial because obviously there's no element of gift or anything. If it was left to surviving spouse, then there's only going to be potential inheritance tax implications on second death, and that can potentially be managed. And again, the benefit of that is if it's left to you on second death, there is also the residential nil rate ban that will be passed on as well. So you may, by doing that, fall outside the IHT thresholds. Again, can't comment on that without knowing the wider circumstances. So it would make things easy from that perspective. Obviously, from your perspective, if you're throwing £100,000 into something that you don't own, although ultimately you will end up as owners, assuming that's, you know, nothing changes in the intervening years, then you might want to take the view that, well, what protects me? So again, there are lots of things to bear in mind on that, and there are things that you could consider. Again, going back to things like declaration of trust, or you could even potentially consider some form of restriction on there. There's lots of things, but again, that would be something to discuss with myself and an estate planner to look at what are the most favourable options based on what everybody within there wants to achieve.
Yeah, and then in terms of that all made sense. That was very useful. In terms of inheritance for my siblings, in my head, it was sort of the case of my inheritance would be a quarter of the house, and theirs would be 3/4 because there's 4 of us. So I would need to find that value of 3/4 of the house. Obviously, it's up to my parents what they decide, but in my head, in terms of fairness financially, I need to then find 3/4 of this house.
Yeah, and again, that's where, you know, trying to formalising different scenarios will help, because you could end up in that position where you've got to find somewhere else to live, or there's going to be an enforced sale on the property. So that, again, if you have disputes with your siblings, they could enforce the sale as beneficiaries of the estate. So you need to, you know, look at how can you protect yourself. Again, could you build in things like lifetime tenancies? Again, more of a question for an estate planner, a legal mind. But there are lots of things that you need to consider, both if it's, you know, this way around, or if it's the other way around, where the annex is going to be built at the children's property.
Yeah. Okay. But sorry, a final thing. I won't keep you anymore. If I'm putting £100,000 of my money into the annex, and that's ultimately not necessarily going to add that much value to the house. That's where it gets complicated with inheritance.
Yeah, I mean, you could structure it differently. It could be potentially a loan. So on the death of your parents, that loan's be paid to you first, and then the rest of the estate gets divvied up.
Right, okay.
There's potentially different ways you could do it. You know, we'd be here for hours and hours trying to sort of box up the scenario. So again, it's just about trying to give some top-down guidance, and just try and answer a few questions for now.
That's great. We'll be in touch then about another meeting. Thanks a lot.
No worries.
Brilliant. Thank you. Thank you for the questions. So now we move on to Mole. I've probably pronounced that incorrectly, so I apologise. You have to pay a market rent to your kids, e.g. a standing order. This shows them as beneficial owners, and you as a tenant. If lump sums are drawn out of the account by your kids and spent, that normally.
Yeah, I sort of think I get the gist of that one. Yeah. So the thing is, with a lot of these regulations, revenue could keep a close eye on it. They could, you know, give it a once over. The file could get picked up in 5 years. You might get lucky and no one ever looks. So it's very, very grey areas, and you know, certain clients will want to go to the nth degree to make sure that everybody's protected and that nothing can ever come back and bite them on the backside. Others are happy to take the risk. The key thing really is to know what the potential risks are and how you can mitigate that. So yeah, theoretically, you know, if people are just spending the money that's going in as rent, no one knows where it's going, chances are no one asks any questions. But if they do, and it's looked at and it's proven that that money's effectively going back to the parents in a roundabout way, you've just got to be aware of that.
Does that answer the question? Okay. Yes, so we move on to Liz Butt. If I finance an annex on my daughter's land under the Caravan Act and thus mobile, is it considered a chattel for IHT?
Yeah, it would again depend. If you gifted the money to your daughter, it would be her estate where that would be tested for IHT. Obviously, there's a 7-year issue as well, but assuming that we're outside of that, you gave her the money 7-8 years ago, she built the annex in her garden, it would be an issue for her estate. But yeah, it would be an asset. Whether it's constituted as an outbuilding as part of this, I don't know. That might be more one for you.
Well, from the
James, is it an outbuilding?
if it's given full planning permission, then it's classed as an ancillary building. And if it's if there's certificate of lawfulness for it as a mobile home, then it's considered a mobile home.
Well, if it's considered, yeah,
But they are outbuildings, but they've got different designations in terms of planning.
Well, if it's considered as not part of the title to the property, then yeah, it would be a chattel. It would just be another asset of the estate. If it was part of the title to the property, it would just form part of the main residence.
So it's not very clear actually what it would be.
I would guess if it's movable, and I guess by the it's a movable asset, then it'd be basically treated as a car, a caravan. So just a chattel.
It's a chattel. So would it attract a IHT?
Yeah, it'll all be part of
it would be part of her estate.
Yeah.
Okay. And okay, thank you very much.
Okay. So this is Andrew. I'll just read. I think he's just reiterating what he verbally said. So my mother sold her house. Half of the value was given to my brother and I. She also gifted me. She also gifted me the price of the annex. To manage issues of fairness, we added a hodgepodge rule to my mother's will, covering the additional gift, with the gift depreciating over 20 years. After 20 years being marked as 0, this means that my brother would get the current value of the annex gift at the time of my mother's passing, prior to splitting the rest of the estate. You see any issues with the approach? He's asking the question.
Yeah, I think this is.
We've been through.
Yeah,
it.
I
think we have. Yeah, sorry.
Yeah. So no,
I shared it. I don't. Yeah. If there's anything obvious, obviously, I'd appreciate being told. But
Yeah, no, I think obviously what the advice you've been given by your legal representative will cover a lot of that off. But
yeah,
obviously every approach is different, every client's different, and again, individual consideration on that.
Yeah, no, that's fine. That's fine.
Thank you, Andrew, again. So Amanda Ellis, since Jeremy Hunt changing the law on stamp duty for property with annex, will that affect me with a separate annex in the garden?
I get stamp duty is only payable on residential dwellings or commercial property, so I don't think it would be an issue for an annex. Is that something that you
changing the law? To be honest with you, Amanda, I'd have to go and do a bit of research into that. I guess it would affect the stamp duty value because the annex will increase the value of the overall property without a doubt. So, but I don't believe there's a separate stamp duty for the annex. And I know there's been a lot of changes in multiple dwellings on a single site, and circumventing stamp duty. So I've not really answered your question, but I will go away and have a look and try and come back and come back to you with a bit more information, if that's okay. So we move on to Jim. My biggest concern is, having funded an annex at our daughters, they subsequently decide they want to move, divorce, emigrate. Obviously, we would have to move out so as not to restrict them. How is our initial investment safeguarded to, say, buying a flat?
Yeah, a good question, Jim. And this sort of reiterates what I was saying earlier around the advice being hand in hand with an estate planner, because what they can do is formalise that. So you could basically write an agreement out that covers any different scenario. Divorce is really a key one, because again, in a scenario where parents sell their property, gift a chunk of money to son, daughter to build the annex, if they then get divorced, then will the divorcing spouse be able to claim half that value? Well, yes, they would. But if you've got things like declarations of trust, that can protect you against things like that. And again, if they want to move, also for disputes as well, because with the best will in the world, and you don't want to think about it. If there was a mass dispute and they no longer wanted you living in the annex in their garden anymore, well, you need to be protected against that. And then again, another scenario would be one again we don't want to think about is if children predeceased you, is what happens then? You are in the annex in their garden, and now that estate is going to be going through the probate process and going to whoever they designate their property is going to go to. So things like the declaration of trust, things like rights of occupancy, wills, that will all help to finalise it and protect your interests.
Okay. So just going back to Amanda, in terms of stamp duty, you only have to pay extra stamp duty when you're buying a house that has an annex on the land. So if you're selling the property with the annex, it doesn't affect you. It's only if you're buying property with an annex that comes with an annex, and then of course you'll pay the stamp duty on that. Robert, we've been informed that an annex is council tax exempt, but have been informed otherwise. The council tax, there's different bandings. It also depends on how much care and assistance the person living in the annex requires. I think it's 100% exempt if they require full-time care, and then it's like a sliding scale on that. And I can give you a bit more information on that, or you well up to speed on the.
Not much on the council tax side.
Yes.
But yeah, we can always go and research that.
Sorry, I just say on this, sorry to interrupt. My research is that each council has their own rules, and you can find the rules available. The common trend is if you're above 65 years old and a member of the family, you usually, in most areas I've checked, do not pay council tax at all. If not, if you do have an annex and you're not over 65, or you're not a member of the family of the owner of the main premises, then what I have seen is that you get to have a discount, and that can range right across the board to like 50% of the council tax of the main property. And that's what I have found.
Yeah.
Okay. Where I live in Woking, it is if you're over 65 and you're a family member, you don't pay council tax as long as it is deemed part of the property. If you get planning permission as a separate annex, not as part of certificate of lawfulness, i.e. it's not deemed as a separate residence, then you'll be treated as a separate residence.
And that's in the Woking council, because we don't get one in Surrey Heath, you see. So
sorry, say that again.
You are under the Woking council.
Yes, so you'll probably find it very similar. The round in Surrey, it seems to be common that it's 50% of council tax unless you're over a certain age and a member of the family. So, like my mother will not pay council tax. That's what I've been informed so far. I'm still waiting to find out, but for sure. But that's what I've been informed.
Yes,
we're under 65, you see, but one of the persons is that we are family members, but one is disabled. So
yes, and I think that was covered. There are special exemptions. So if you have, I believe, learning difficulties, or you have a disability, a physical disability, there are discounts on there. Literally go onto your council website and do a search on Annexe. That's what I did for us, and it came up immediately.
So that's how I understood it. It is a bit council specific, but as a sort of rule of thumb, it's 50% reduced depending on your council. But if you are over 65 and dependent, then you're exempt. Or if the person living in there is severely disabled, for instance, and under 65, then you're exempt.
Yeah, and it could be that you get 25%, but yeah. I can't remember the full details for all the different disabilities. I think physical disabilities get a full exempt, and then intellectual disability, I don't mean it in a horrible way, but you get what I mean. If you have an autistic daughter who's living in your annex, then you can get a reduction to 25% where I live.
But does the banding of the main property increase then?
Well, mine, I don't know. I don't believe so. No, but mine's already at the top, so I wouldn't have a clue. Unfortunately, I wish it wasn't at the top.
No, I've just had confirmation from a colleague who's listening in as well. That it doesn't. Your property banding will not change.
Yeah. The only I know, just for other people's information rather than me asking a question, but I did find out if for example I did decide to charge rent to my mother, then it would be the certificate of lawfulness, which allowed it to be built as part of the Caravan Act, would it basically become invalid. I would have to apply for planning permission. So I can't rent the property officially out because it's ancillary to my property.
So that was part of the clause for the planning, though, was it?
Yeah, I think we also got asked that question in advance about renting it out. Again, the legalities of the Caravan Act, etc., are a little sort of outside of my sphere of knowledge. But all I can say around that is, if you did rent it out, if you've got a mortgage on your property, that might preclude you from doing it. The lender might not like that, and any income should be declared to HMRC and taxed by a self-assessment as well. So
I understand that. I understand what you just said there now, but the problem we had we've got two planning permissions. We've got the both.
Yep.
We've got the certificate of lawfulness, and we've got the full planning permission.
Did you gain both? Did you?
Sorry?
Did you gain both, or are you applying for both?
We gained both.
Very good.
But then we still was told that it can't be rented anyway.
Well,
Okay.
I think there's a bit grey, because without a doubt, particularly with the planning application, the full householder application, yeah, there is a stipulation in there that it can't be used. So basically, it's got to be used in conjunction with the main property. And if you're renting it to somebody you don't know, then it's no longer being used as part of the main property, and therefore it's in breach of the planning decision. But if it's being used within the family, and there's some money going towards the upkeep of that building that they're using, in my world, I don't see that as necessarily a rent, because and there's no legal agreement. You're not signing a 12-month lease with someone that you don't know.
Expenses effectively, aren't
Yeah,
Yeah.
I think that's a very different. I mean, once again, I'm not an financial advisor on that, but what I am sort of reiterating is, if you rented it out to someone you don't know with a proper agreement, like a proper lease, then yes, you're in breach of planning.
Yeah,
definitely.
That's just a question.
Yeah, I also got told, and it wasn't relevant to me anyway, but it was also the comment from the planning enforcement officer who came and had a look at the property. His statement was, it can't be used for Airbnb or anything like that.
Standard, yes.
Okay. So I don't mean to put. We had a list of questions that were sent to us in advance.
Yeah, I'm just reading through these, James. I think most of them have been answered.
So that somebody wanted to scrap the list.
Yeah,
so we had Denise Hall asked quite a few. Denise, have we answered your questions? Maybe just put a yes in the box.
I would like to think you did, but unfortunately I've had IT issues, so I've missed half of your presentation.
Oh, joined the club 5 minutes before we were going to go live. My computer decided it didn't want to work anymore, so
yes.
Apologies for the slight stuttery start, but we had to switch computers out. So do you want to, is there anything specific that you would like us to recover?
The main one really was how you calculate any additional value to the property, the main property, by adding an annex. We've been told different things, that you should get the property valued and then get the property valued after the annex is built, or that the annex will just add 20% value to the current property that it's going to be built on.
Yeah, I think it comes down to how formalised you would need it to be there, Denise, because obviously if you have a formal valuation done, that would constitute, if it was done by a surveyor, proper chartered surveyor, there'd be little argument from anybody that that didn't represent the true value of the property, whether that's before or after, and that would give you a very accurate idea of the uplift in value. You could estimate it. Any estimations could potentially always be challenged in a probate scenario. Again, it depends on how thoroughly it gets looked at, if that ever became an issue. So again, if you'd anticipated that property had increased in value by 70%, subsequently died, it went through the probate process, if the 70% upward was put on the value of that asset, probably in vast majority of cases it wouldn't be challenged, but it could be. Whereas if you've had the valuation done, that really becomes a hard and fast figure.
Okay. Lovely, thank you.
Was there anything else, Denise?
I can't even remember my list of questions after the stress of trying to get back over.
There was how much does an annex out just to cover? How does it affect inheritance tax? What do you need to be aware of for future finances?
Yeah, again, we've covered a few different scenarios on this, but yeah, it depends on the nature of how it's funded. Again, if you're going to sell a property or just gift money to a son or daughter to build it, 7-year rule applies. It is a potentially exempt transfer. If you're going to do it in a different way, potentially that could change. I'm more than happy, Denise, to email you because you've got a few questions on there. I'd be happy to email you a response to each one if that's easier for you.
That's very kind, thank you.
Okay, brilliant. Then we had Audrey Beavis. Did we answer your question? Okay. Robert Basham, did we answer your question? Is that Robert now? It's just
it was just a question with regards to, you said gifting. You said gifting a lot, but does change of ownership is the same? Is it the same with gifting?
It's the same thing, but a change of ownership implies a consideration was paid. So you could sell the property for a consideration. Again, that's a disposal. A change of ownership is basically just if there's no consideration, you're gifting it someone. So again, from revenue's perspective, what they don't want is people trying to circumvent basically the
7-year rule you say now.
Yeah, so gifting it, you can changing the ownership or selling, you're going to change the ownership. Gifting or selling, you're going to change the ownership. The difference is whether a consideration was paid or not, and whether that was a market value consideration.
Yeah, we understand that, but that's I go back and reiterate anything I said before. The idea of it is the value of our property will pay for the annex.
Yeah, so again, if depending on how that is structured from a legal perspective, if the money is used effectively as consideration, if all the legal paperwork on the transfer of ownership states a consideration, then yeah, it's a sale. And that future capital gains implication would only apply the difference between the consideration and the sale figure.
Okay. Is that it, Robert? Anything else?
Yeah, I think so. I'm trying to get my head around it, to be honest, and I think so.
Yeah, again, there's a number of circumstances where things could change, many different implications, all individual considerations. So again, if you want that guidance, we can have a separate chat.
Yeah. Okay. Valerie Tutlet, did we answer your questions? If you're still there, we can respond to all of you in writing as well to the answers. And then Liz Butt, did we answer your question?
Are you able to put the email address back on the screen there?
Hello, sorry. Yes, I think so. Though I have a lot of questions, so I might book a 15-minute session with Paul.
That's
I think.
fine.
Can you see the slide with what's next and the contact details?
Yeah, I think so.
Yeah. We'll follow up with you guys with the details, and so that we can well, yeah, get these, you know, get any meetings booked or whatever. Is there, I'd just like to thank you. So are there any more questions that people have before we sort of wrap this up?
No.
No, don't think so.
I've got one.
Sorry, go on, Brian.
I've got one. Sorry. First of all, I copied the email address down, and the message I sent you has got the wrong email. Anyway, my question was, if you don't mind, I have a property worth about 700k. I want to gift it to my son, family, and then he wants to build me an annex in the garden. Can you see any problem for doing that?
Well, again, the first thing there, Brad, would be if the ownership is changing, you're gifting it to the other one. Again, 7-year issue.
Yes.
You know, there could be a consideration around the deliberate deprivation if you've just given the whole asset away. But again, the provision of the asset being built in the garden probably will negate that. I think as well, there's possibly a little bit of a grey area regards gift with reservation of benefit, because you're going to be still living effectively deriving some enjoyment from the asset because you're going to be in the annex within the premises. Again, one way to potentially work around that is the payment of rent, potentially, because again, you're sort of creating that line to say, I'm no longer owner. For me to enjoy this asset, I have to pay.
Okay.
Yeah, it might be something that we'd have to have a bit of a more detailed chat around, because the gift with reservation and benefit rules are quite complicated.
Everything's complicated. But thank you.
Any more questions? Anything else before we wrap up, Paul? Is there anything you wanted to wrap up with?
No, I think we've covered everything that was.
Rent, sorry. So the rent you just mentioned there, for argument's sake, that's taxable then to the owner of the property.
The rental income.
Yes.
Yes. But again, I think we then have to maybe consider, you know, is it permissible? Yeah, you know, there's lots of different things to bear in mind in that calculation. But yeah, any income is taxable on the marginal rate of the receiver.
No. Okay, thank you.
Thank you.
Thank you very much. Okay, like I said, we'll follow up with an email with all the information. If you have more questions, particularly about the the inheritance tax, please book a call with Paul. And equally, if you've got questions about planning, building control, the projects, some wider questions about the an annex or the mobile home, then please get in contact with us directly or myself, and we'll be more than happy to help.
Okay, thank you.
Thank you.
Thank you very much.
Thank you.
Thank you. Bye-bye.